Okay, good afternoon to everyone. I hope you can hear me and see me well. If not, just feel free to write it in the chat so that I can fix any problem we may have. So good afternoon, welcome back to this new webinar by the International Energy Agency. I'm really happy to be with you again today to continue our discussion on energy modeling. So today we will look further into the power sector, and I'm really sure that this will be a topic of interest for many of you. We will be joined by my colleague Yasmin, which will be presenting this topic and also will join us later during the presentation in order to answer questions you may have. I see there is a message in the chat. Okay, yeah, thank you. So just a quick reminder, today, as I said, we are at webinar number 7, which is actually the 8th, if we think about the fact that we had the technical pre-launch. So we will have this lecture today about the power sector. Tomorrow, we will have an additional lecture, so the 4th one on modeling, which will be focused on the hydrocarbons supply. So focusing on the oil and gas sector, which is also a very important piece in this puzzle. Really, just a quick recap. As for previous events, feel free to ask any question you may have in the Q&A box. Otherwise, you can raise your hand through the Zoom functionality, and I will give you the possibility of unmuting yourself and also turning on your camera so that you can directly ask your question, whether it's to me or to my colleague Yasmin. And third option you may have, maybe later rewatching the presentation, rereading the slides, or trying to do the exercise on the power sector modeling. You can write an email, whether it's to me, to my colleague Zakia, or the Africa program email. So if you have questions which are specifically like oriented and like touch modeling issues, I suggest you to write directly to me. If I'm able to answer, I will definitely do it. Otherwise, I can forward it to the colleagues, for example, today to my colleague Jasmine, which is one of our main experts in the power sector here at the International Energy Agency. So I will just start with sharing with you a few considerations and findings on the power sector, just to insist on why is the power sector important. So we are looking at this sector because it's key in our energy system. So if you look at the world share at the global scale, the share of electricity and heat, but really let's focus more on electricity. Sorry, I can activate the laser pointer so that you can see better. Okay, so here in this first graph, you have the share of electricity and heat demand by end use sector. So the big message to bring home, let's say, today is that the power sector is the biggest CO2 emitter. So here you have different, like in this chart, you can see the difference in terms of share of electricity and heat demand by end use sector. So you have the total final consumption, you have the industry, you have the transport, which, as you can see, is very small. But because right now the electrification of the transport sector is at an early stage, I would say, we have residential, we have services, and we have agriculture. Here you have a second chart, which is the share of power sector in energy-related CO2 emissions and in primary energy demand by fuel. So here, in terms of percentage, you have the CO2 emissions related to the power sector. And then you can see the different percentage here with respect to the primary energy demand by fuel. So the power sector is really the key to decarbonize the energy system. And that's why we need accurate modeling, because we need to be able to provide huge insights to decision makers, especially since right now we have many goals. One is, for example, 13 goal from the SDGs, which is really oriented to the climate change issue. So this was the picture for the entire world. We can see the difference with respect to Africa of the same exact chart. So we have, in terms of percentage, the share of electricity and heat demand by end-use sectors of the same sector. We can see how first there is a huge difference, because if we look at the entire world, we see that there is like depending on the end-use sector, but you can see that it many times, especially here at the residential level and also with respect to services, plays, let's say, an important role, but we don't have the same when looking at Africa. And we have, let's say, comparable values also when we look at the CO2 emissions and the primary energy demand by fuel, like more or less the in terms of orders of magnitude and like proportions. You can see that Africa has the same kind of values and trends with respect to the entire world. So this is some global, let's say, it's on the global picture, but let's have a look at maybe some very recent trends in the power sector. And if we look at the electricity consumption per big region, so here you have it, it's not by state, it's really by, like sometimes we are talking about countries, because we have China, which even though it's one country, plays a really important role in the global energy say system and global picture. So we have China, which is here in red, for example, and we have Africa here as a whole continent. We see that in 2019, both these regions had a specific value in terms of electricity demand. So here you have this electricity demand, which is measured in terawatt hours. But moving, let's say, moving ahead in different years, you can see that now we have 2020. Clearly, as you know, 2020 was the year in which the world was impacted by the COVID-19 crisis. But we, as the IEA, like through the analysis we usually do, we have seen that the electricity demand has proven being resilient to the the COVID-19 shock, because the reliance on electricity increased. So future demand growth is concentrated in Asia, and you can see it with this animation, in which we can see that the electricity demand is growing, and we see, for example, that till 2020 and also ahead in the next decade, the European Union as a whole was, let's say, at the third place when looking at electricity demand. But close to 2040, India replaces in the European Union in this, like in the third place of the podium, and we can see now that we have here, so China and India, which are the biggest countries in terms of population in the entire world and are both in the Asian continent, are at the first and the third place when talking about electricity demand. So here you can see as a white dot the values we had in 2019. So you can see how in this more or less 2 decades we have really China, which is increasing at consistently, and the same is for India, which is more than doubling its electricity demand. But we have countries like, for example, the United States and the European Union, which is not a country, like so a region, specific region, which increased, which are expected to increase not very much. And then we have, for example, Africa, which as it's for India is more than doubling its electricity demand. So we have really the entire world, which is going through an electrification of the energy sector. and we see these regions which will be the regions in which we will have this really huge trend toward electrification in the next decades, also because many other regions, like for example the United States and the European Union, already went through this track. Okay, so solar PV is becoming the new king of electricity, as we often say here at the IEA. Here you can see the change in global electricity generation. So from 2000 to 2019. So we can see this is in terms of changes. So it's the additional electricity coming from different sources. You can see how, for example, in these 2 decades, we had different trends in terms of, like, with respect to different technologies. We can see how coal increased. We can see that in the past 2 decades, solar PV was among these 5 categories, the least, let's say, the source from which the lowest amount of electricity was coming. But as I already introduced you in the previous lectures, we are doing some modeling, trying to anticipate what will be the future till 2040 in particular, which is our time horizon in many of our analyses. And here you can see the results from our modeling exercises using what's called the STEPS scenario, which is the stated policy scenario, which I remind you is that scenario which takes into account all the commitments from all countries in the world. So these are the in place and stated policies from these countries, and we can see that the picture is completely changing, because we can see that the change in global electricity generation for coal will be negative. So we expect less and less electricity coming from coal in the next 2 decades. But on the other side, we have a huge increase in wind and solar PV in terms of global electricity generation. Again, I remind you, here we are talking about just the change. So it's not the total electricity coming from these specific sources, is the additional. So the change in this case from 2019 to 2040, as it comes from our modeling exercises taking into account the STEPS scenario. So solar PV is now the cheapest source of electricity in most countries, and this is in part due to low-cost financing, and is in this scenario set to triple before 2030, and under current, so STEPS policies, but also proposed policies, because we can see that there is also an alternative future, which is depicted by the SDS scenario, which is the Sustainable Development Scenario, which, again, I remind you, is the one which takes into account all commitments the world decided to agree on. For example, the 2030 agenda from the United Nations. So here you can see a almost complete phase out again, I remind you, we are talking about changes. So in these 21 years, let's say from 2019 to 2040, in terms of changing global electricity generation, we can see how coal is decreasing a lot, and we have the renewable part, which is increasing even more with respect to if compared to the STEPS scenario, because we have wind, which is almost doubling in terms of changing global electricity generation, and it's the same it's for the solar PV, that here you can see is really like, here you can see the reason we are used to call it the new king of electricity. So now the question is, in order to achieve these levels in terms of electricity generation, we will need, at a global level, but especially in Africa, we will need to mobilize investments. So Here you can see, for example, what was the average annual power sector investment needs in Africa. Here, this was the value that was invested in 2018 in the entire continent. You can see the total value in terms of $1 billion. So we are close to $40 billion in terms of investment in the power sector. And you can see the fragmentation between generation and electricity network. If we look at the stated policies that countries in Africa commit to, we need, in terms of annual, so I remind you, we are talking about average annual for the entire continent investment into the power sector. We see that we need a doubling in investments, both in generation and electricity network, so as a total, as a whole. But you can see that, for example, we see how the generation increase a little bit, but we have huge investments needs, especially when looking at the electricity network. So moving from the stated policies to the Africa case, which is our third scenario, which I remind you is aligned with the 2063 agenda from the African Union, you can see that we are talking about like a level of investments which is twice the stated policy scenarios needed investment, and we are again talking about 4 times the investments we had at the continent level in 2018. Again, you can see how also we have an increase in both generation and electricity networks, investment-oriented investment, but really we need to support the electricity network investments in order to bring that electricity which is generated at, let's say, central level to all areas that right now don't have access to electricity. Here you can see a fragmentation of this total investment needed in the Africa case with respect to the geographical area in which these investments are needed. So you can see that Nigeria and North Africa are, and also South Africa and the Democratic Republic of Congo need huge investments. And here you can see the rest of Africa, in which Rwanda is clearly included. The question now is this level of investment mobilization possible? And in order to answer that, we looked at the historical power sector investment in selected regions as share of GDP. So here you can see that these investments you can see on the left charts. So here we are talking about the stated policies and here scenario, and here we are talking about the Africa case scenario. Those two levels of investment, so more or less $70 billion a year. I remind you, we are talking about average annual investments, and here 120 billion a year dollars in terms of investments represent respectively more or less 6% of the total GDP of the entire region, and in this case we are talking about more or less 2.4% in terms of investments. If compared, if we compare these values to what other regions which have been able in the time window between 2000 and 2018 have been able to achieve really high level in terms of investment mobilization, we can see how, for example, India used has been able to direct in terms of power sector investment a share of GDP, of their GDP in terms of annual investments, which was above the 2.5% of their total GDP. China was able, on average, to mobilize 2% of their GDP into the power sector, and the Southeast Asia was able to do it, investing more or less 1.4% of their GDP. So total GDP as a total, as an area, as a whole area. And this information come from our Africa Energy Outlook 2019 that we published, and we are replicating this year with the Africa Energy Outlook 2022. So you can see how when talking about the percentage of GDP that should be invested in the power sector, we have really comparable figures. So we think at the IEA that this is achievable. So we really need to go and push for this level of investment. So before moving with the lecture, I would like to ask you to connect to the menti.com website so that we can have a quick poll just to have your feedback on some specific questions. So I will share my screen, and now in a few seconds I will put on the in the chat the link you can use to join this online polling exercise. You should be able to find the link in the chat, and the code you can see there. I'm also copying it in the chat. It's 98333357. So I hope all of you are able to connect to the Menti www.menti.com website. I will start by reading the question. So the first question is, rank these sectors according to their electricity demand, like from highest to lowest, for Sub-Saharan Africa, excluding South Africa in 2019. So just to contextualize, we are talking about just Sub-Saharan Africa. So we are excluding South Africa, not for like specific political reason, but just because South Africa is really an outlier when talking about power sector with respect to the rest of the region. So that's why sometimes when we do modeling, we tend to exclude South Africa when aggregating all the information, like the data that we have for the entire region. So in this case, you are asked to focus on Sub-Saharan Africa and to rank all these sectors according to what you think are their electricity demand from highest to lowest. So here we can see that residential is at the first level. We have actually just one person. Okay, so 3 people already answered. We have industry, residential, transport. Right now, agriculture went to the 5th place. So I give you a few seconds more to vote. Again, remind you, we are talking about just electricity demand. So just focus on electricity. Okay, so 6 people answered. Feel free to continue answering. So we have almost a perfect picture, let's say, of what's the situation in Sub-Saharan Africa, because right now we have the residential sector, which is number 1, but we have really the industry, which is really close, because they're respectively like demand in terms, they respectively demand on a yearly base, respectively 80 terawatt hours and 75 terawatt hours. This is for 2019. So they are really close. Then they are followed really like far from those values, like more or less half of those values, by the services sector, which accounts for 40 terawatt hours. And then we have very far from that, the transport and the agriculture sector, for example, the agriculture business sector, which, for example, to give you an example, the agriculture sector at the Sub-Saharan Africa level right now, really, and also the transport sector really use like 0.1 terawatt hours per year. So it's really far from industry and residential and the residential sector. So I will move to the next question. which is, can we expect the electrification of final uses in the future? Sorry. Okay. Of final uses in the future to decrease, remain about the same as today, or increase? So just tell me if you think that the final uses in, again, we are talking about Sub-Saharan Africa. If you think that the electrification of final uses will decrease, remain about the same as today, or increase? Okay, so I see 4 or 5 answers. This was a really simple question, but the idea of this question was really to have you keep in mind that we are going to like a process of the electrification of all sectors, but in particular also final uses. So the correct answer clearly was increase. And we will see in the next slides what is really this trend, how we can, let's say, model this trend, and what we as the IEA, but also other entities that do this kind of analysis think the final use of electricity, of energy in the future will be, let's say, shifted through the use of electricity for final uses. So that's it for the moment. We will have a few other questions later during the presentation. So now I will move to the lecture by my colleague, Yasmin. So let me know if you're able to see and hear.
Hello, everyone, and welcome to this session dedicated to the power sector. My name is Yasmin Arsalan. I'm a power sector modeler and analyst within the World Energy Outlook team here at the IEA. So today, together, we'll look at the basic principle and characteristic of the power sector. We will first have a look at how it's functioning without wind and solar PV. Then at the end of the presentation, we'll come back to these newer technologies and see how they are impacting the power system's operation. As we all know, power systems are very complex systems. They have a multitude of actors, multitude of elements and interaction between them. I'd like to focus on the most important one here. So first, the demand side of things. You can see here the different centers where electricity is consumed, be it a household, be it industries and businesses, commercial facilities. Second, then on the supply side of things, where this electricity is produced. So this is the generation facilities. And third, between those two groups, you have the grid, transmission, distribution grids, and other related infrastructure, and the grid that connects those two broad groups. So this is for the grid connected element of power systems. You have, in addition, some off-grid elements. They can be divided between mini-grids and standalone systems. We need now to remember that this is a picture taken at one point in time. For example, regarding the national grids, traditionally, this has been only one direction flows from generation centers to demand centers. And now this traditional way at looking at flows is becoming blurrier and blurrier. You can see that now more and more consumers are generating their own electricity and injecting it into the grid. So this traditional unidirectional flow is becoming more multidirectional. So that is on the national grid side. On the off-grid side, we can think that some off-grid elements can at some point be integrated in the national grids. Mini grids can be connected at some point in time to the main grids. So this presentation, we will look mainly to on-grid system, and we will leave the off-grid ones to a separate webinar. Today, we will focus mainly at the supply side of things. we will focus really at the generation part of the power sectors. Of course, demand side is really important. Electricity demand level, electricity demand shape will really impact the power sector's operation and their evolution over time, over the course of the year, over the course of a month, over the course even of a day, or even at a shorter time frame, will have impacts on the operation of power sector generation. So more on demand. We looked yesterday at end-use sector energy demand. Electricity accounts for a very important part of it. At the global level, we are talking about 1/5 of end-use sector energy demand that are met by electricity. And if we consider that electricity has a higher conversion efficiency compared to other fuels, other energy vector, then this share of useful energy is even much, much higher. Going forward, one very important characteristic to keep in mind when we are talking about electricity is that it cannot be stored in large quantities or for very long periods of time. We have some exception, thinking about large hydro storage facilities, for example. But the point is that it's very different from other energy commodities such as oil, such as gas, such as coal. The consequence of that is that we need to balance the system all the time. Electricity demand must be met at all time by electricity production. And for all this variation that we see until here, we looked at electricity demand. So this is sitting at this part of the world energy model. And electricity demand need to be balanced at all time by the electricity supply. So this is considered as an input to the power supply module of the model. In some other model, where final energy model is not as a part of the whole system, this would be considered as an exogenous input. So here we have final energy demand that is endogenous and that is feeding the supply part of power system. We also have a feedback loop from the power system to final energy demand, and this is reflected through the price of electricity. So electricity prices will determine also the competition that occurs between fuels in final energy demand section of the model. So if we look at this point with a very, very simple schematic, we can see how electricity demand is different from electricity generation. In electricity generation, we account also for the grid losses, the own use of power plants, some electricity trade that can occur between countries, between region. Let's think about power pools where trade can happen. So the total generation needs to be met by the producing facilities, which determines the electricity prices. And then there is this feedback to end-use sectors' demand. Now let's move on to the next section of this power supply modeling session. So we will touch upon more in detail what are the sub-modules of the power sector module in our model. So if we have a closer look at the power sector generation module, we have inputs flowing in. We need a lot of historical data, such as capacity by technology, by year. We need information on the generation mix, the fuel consumption. On top of that, each technology has a different feature. The cost, the capex of each technology will be quite important to drive our module. We have also learning rates, which will make this cost evolve over time as we have learning by doing. We need some grid elements, such as the length of the line, and also capacity factors. On top of that, some elements are linked to projections from other modules. So, as mentioned earlier, we need electricity demand from the demand module. On top of that, fuel prices that would come from the supply module, and CO2 prices in regions that have applied these kind of policies. Talking about policies, we have constraints also. Other policies than CO2 pricing can be renewable energy targets, but other constraints can be market or non-market related or technical. And as output, we are able to derive capacity, the network length, generation, fuel consumption, cost, investment, and electricity prices that would then be implemented as a feedback loop for electricity demand module. Now let's have a closer look at this black box. When we model the power sector, we need to remember that this is a multitude of submodules that needs to be considered. From distributed generation to nuclear generation. One of these modules, for instance, combined heat and power and heat plants, will have heat demand as a driving element. Water is a driver for this desalination one. Renewables need to take into account the available potential for each location, etc., etc. And as an output of each of these very complex submodules, we have the evolution of capacity, fuel mix in terms of generation and use. We have the emission, we have the investment and prices. So this is a more detailed diagram of the power sector module. Here you can see that there are two central points in this module. We have the capacity addition mechanism on the left. So this is the module from which we derive what type of capacity needs to be built to meet electricity demand. So the inputs in white of these modules are investment assumption, prices, efficiency, historical capacity, and retirement. We also have in green some calculation that would have an important impact on this module. Electricity demand, obviously, we build this capacity to meet demand. And we will look at this module first, then we will move on to the dispatch mechanism. Once we have those plants, this installed capacity, how do they operate? So maybe before digging in, an important consideration to have in mind here. When we are talking about the needed installed capacity in a power system, there are two components. We build it to meet demand, but also because our power plants have lifetime. So existing plant today will be retired in the future. And so new capacity addition will need to compensate for these retirements, and on top of that, increase to meet the new demand. So let's start with the capacity addition module. So we need first to remember a key characteristic of the power sector, which is that supply and demand must match at all times. And looking at demand, we have a constant variation over time. So here we can see the hourly electricity demand, and we can see how it changed over the year with strong variation among seasons, which would depend obviously on the country. If we could look at monthly changes, we see as well some variation. And during the week, we see higher demand during working days. And during the day, higher demand during daylight hours compared to nighttime hours. So to model power supply, hourly electricity model can be used. We have this kind of models here in the World Energy Outlook team for several regions, the United States, China, India, and European Union. But this is quite a complex kind of modeling, and it requires a lot of data. It requires very powerful computing capabilities. So when we look at the annual granularity, we make some assumptions, some simplification to still consider the granularity, the time period granularity, but keeping it in a simpler way. A very common simplification is to reorder the hourly electricity demand from the highest point, the peak hour, to the lowest value. And this is what we call the load duration curve. It can be expressed in absolute value, or as you can see here, relative to the average electricity demand and in percentage terms. So for example, here we see that the peak is about 170% above average demand over the year. So this is how we proceed. We can divide this load curve in several homogeneous segments. And the most typical one being peak, mid, and base. So 4 periods of time here, the highest one being the peak segment, the lowest, the base load segment, and in between 2 mid-load segments. So given the evolution of electricity demand over the projection period, the evolution of total dispatchable capacity can be estimated through 2 steps. So first, the peak to average ratio. Remember this 170% above average that we saw in the previous example. So we calculate this peak to average ratio based on the analysis of historical data and the evolution of different end use, for instance, cooling needs or electric vehicles can make this demand peakier. Then to have more reliability on the system, it is not only the peak demand that needs to be met. We build the system to meet that peak demand, but we have a level of security. This is what we call the capacity margin. So an additional amount of dispatchable capacity to be sure that we have a reliable system, even if some plants for extreme reason like rupture of supply chains, etc., are down in a certain period of of time, then we have this capacity margin on top of the peak demand to make sure that the system is meeting demand at all time. So coming back to the different time slices. So as we saw earlier, we considered a base load type of plant, mid load type of plant, and peak load type of plants. And for each time slice, the new additional capacity needs to take into account all these three different time slices. So we consider the net addition needed to meet new demand, and as mentioned earlier, the addition needed to replace the retiring plants. Back to the main diagram on power sector module and the two central points of power modeling. So we had a look at additions of new plants. Now we will look at the way to operate these plants once they have been added to the system. So if you look at this diagram, the main inputs to operate the plants are, of course, what is the installed capacity, which was an output. Outputs are in blue, an output of the capacity mechanism. Once we have capacity, then the main drivers would be fuel and CO2 price, efficiencies, historical capacity, maximum capacity factors. And the output of this is generation by plants, and we will see at a later stage fuel consumption and CO2 emission by plant type. So we're really focusing on this part of the model. We have several dispatch mechanisms available when we model how plants operate. This is really aiming at determining which plants, which technology will generate in which point in time, within the hour, within the year, given a number of constraints such as the availability and flexibility, the technical constraints of each plant type. So, given a certain level of demand and a certain amount of installed capacity, depending on the type, power plants generate electricity based on dispatching rules, usually on an hour-by-hour basis. What is important here is the utilization rate, meaning during a year, how often these plants operate. So in gray, baseload plants would operate generally with capacity factors or utilization rates around 80%. 80% of the year, baseload plant would be used to meet demand. Midload would be generally used 50% of the year, and peak load run very much less hours. Really, as you can see on the graph on the left, you see they're used really for peaky demand, and so they have generally much lower capacity factor, generally below 10%. Here in this example, we have 7%. So this is a very useful indicator, this capacity factor. It can be used in the modeling to add additional constraint on the maximum generation of a group of plants. For example, you could set as a constraint that gas turbine cannot be used more than X% of the year. This is used to simulate operational constraints and also grid bottlenecks. One of the most common and most efficient dispatch system is the merit order. So what is the merit order? This is an approach, a least cost approach based on variable costs. This variable cost, we look within each hour, which is the best suited plant, which is the least cost plant to generate. So we rank plants from the lowest to the highest variable cost, measured here in dollars per megawatt hour, also taking into account the maximum electricity that they can generate in that hour. This diagram shows the level of electricity demand on the x-axis, and it helps determine which plants will run, and the consequence, the implication is the price. For example, for baseload plants, the off-peak price would be determined mainly by nuclear, lignite, and steam coal during baseload hour, mid-load, and also for peak load demand. When we average this resulting price over the whole 8,760 hours of a year, we can determine the average electricity wholesale price, the average annual electricity wholesale price. So why is the dispatching mechanism important? This module helps determine a number of very important elements. So how plants are operated over time, how much electricity is produced by each technology, which plants will be generating, and then, and I'll come back to that later, the fuel use and associated emission. And we saw that just in the previous slide, the price. And to sum up, the result depends on many factors. So from the capacity addition mechanism, which plants are here in the system for each year of projection, what are the relative price of coal, oil, and gas that would impact the variable cost and therefore the merit order? Is there a CO2 price that would penalize the most carbon-intensive technology? And again, the changing level of demand. A quick illustration of the result of the generation module for a very specific case that we took from our World Energy Outlook 2019, and especially the focus on Africa. So here on the top, we can see the evolving demand over the period and for different scenarios, and how electricity is generated, what are the different sources of electricity in those three scenarios, the stated policy scenario, the Africa case. So we can see clearly that in the Africa case, demand increased almost eightfold, and here gas, wind, and solar are meeting most of the demand growth. Coming back to the diagram, we have now covered the two main components, addition of new plants and dispatch mechanism. To follow, I would like to focus on other very important elements of this power system, which is how much fuel is consumed by plants and the consequence of it to emission by plant type. So once we have electricity generated from the dispatch module, one key element to consider is the efficiency of these plants. This is really key to determine the overall efficiency of the park and therefore the fuel use by type. The fuel use by type is really important when considering domestic production, considering energy security consideration, etc., etc. So how much oil would need to be imported, how much gas is very much linked to fuel use consumption in the power system. And from generated electricity, we derive that using efficiency of plants. So over time, technical improvements and with aging plants out of the park and more efficient new plants coming in, we can see the evolution. In the OECD region, this evolution is really minimal. But as you can see in China and India, as the demand is decreasing much faster, we have much more new plants coming in to meet that demand. And these new plants are generally more efficient, having a big impact on efficiencies in the park. Once overall fossil fuel use is determined from electricity generation using efficiency, we can derive the total CO2 emissions of the power sector. As you can see in the graph, the increase of electricity generation can be balanced by a decrease of the average emission per unit of electricity generated. This can be linked to two main factors. First, each fuel has a different carbon intensity, coal being the most intensive one, whereas gas is the lowest intensive technology. So a shift from coal to gas would have an impact on the CO2 emission per electricity generated. The second main driver is the efficiency. The efficiency would limit the fuel input per electricity output. So to pursue climate goals, CO2 intensity will need to be strongly decreased thanks to the massive deployment of low carbon technology, but also thanks to a shift to lower emitting fossil fuel technology and improvement of new technology so they are more efficient.
Okay, perfect. I hope you can hear me, and I hope everything was clear and you enjoyed this part by my colleague Yasmin. I will move with the other questions, as I anticipated you, through the maint.com website for online live polling. So you should already have the link in the chat. Maybe I can put it again if some of you connected after I put that in the chat so that you can join. I will move to the next question. I hope you are able to connect. So I will be waiting for at least one of you to answer the question, which is now, which is the largest electricity producing source in Sub-Saharan Africa, excluding South Africa again, in 2019? So you have different sources. You have gas, you have hydroelectricity, you have coal, you have oil, you have wind, you have solar PV, you have geothermal, and you have bioenergy. So let me know what you think is the largest electricity producing source in Sub-Saharan Africa, excluding, again, as I said earlier, South Africa. Okay, I see 5 of you already answered, and it seems that all of you are going to for the hydroelectricity. I see one person which has answered right now gas, hydroelectricity again. Okay, I will tell you that yes, hydroelectricity is right now the largest electricity producing source in Sub-Saharan Africa, and that was right. But you will see how these different sources rank in Sub-Saharan Africa in the next slides. So I will continue with the next question, which is, which source of electricity has increased the most in terms of generation since 2014 in Sub-Saharan Africa, excluding South Africa, again, for the reason I specified earlier during the webinar. So you have the same exact sources, but now I'm asking you, what do you think in terms of increase, relative increase from 2014 till today? What do you think is the the source of electricity which has increased the most? So think about the fact that when we are talking about an increase, a relative increase in terms, for example, of percentage, we are referring to what was the value in 2014 and what is the value today. So it's a bit tricky question, I guess. So I'll give you a few seconds more to answer, and then I can give you the answer. Okay, yeah, the correct answer actually is wind, and it's followed by solar PV. But just because, as I introduced you, here we are talking about an increase, like in percentage increase. So clearly the value of wind of solar PV were the values of both these renewable energy-based sources was low. So actually the increase was in terms of percentage higher, because yeah, the starting value was also very low. So for example, to give you some insights with respect to the previous question, as I told you, hydroelectricity is 125 more or less terawatt hours in terms of electricity production in the entire regions of Sub-Saharan Africa, which represent 53% of the total electricity generation, like we are just talking about generation. And for example, with respect to this question of the increase from 2014, solar PV increased at an higher rate because it was 30% per year, but wind, for example, increased more or less at 24% per year. But in terms of period, we have wind which has increased at a higher level also, like for example, from 2010 to 2019, we have an increase of which was more than 50% per year. So it really depends on the time period you take into account, and the fact that we are talking about a percentage increase. So the less the initial value, the easier it is to have a percentage increase. So last question, which is really an open question. There is no correct answer here. And the question is, what is the first characteristic that comes to your mind with respect to solar PV? So when you hear about solar PV, what is the first characteristic that comes to your mind when you hear that? So I remind you, this is a completely anonymous survey, so I won't see which person is answer in specific word that will now appear here on the screen. So feel free to answer what you think is the first characteristic that comes to your mind, and then we will see which are the aspects that are, let's say, more relevant and recurring in your answers. So I see one person wrote distributed. Very nice answer, which is, let's say, is a different, let's say, framework, a different approach with respect to what has been in the past, the power sector structure, which was the vast majority of the time centralized. But now that we have solar PV deployed, we can also, we have also big power plants which are centralized, which use solar PV as a source, but clearly we also have distributed generation. So we have PV panels, we have renewable energy, clearly, clean source of energy, we have battery storage, which one of you wrote, which is really important because of how solar energy is distributed during the year and during the day, especially, we need storage in order to deal with the uncertainty and variability and seasonality of this source. And I see another answer, which is variable output, which again is really linked to the other person which answered batteries storage. Feel free to write your answers, and we will come back to this later during the presentation. So now I will go back to the, sorry, just a question. I don't see any other answer, but feel free to do it. The website for menti.com is open, so you can continue answering, and then we can come back to that again. I will just move to the presentation, so you should be able to see the PowerPoint. And just to contextualize those questions with respect to what is the current and future technology that will be or is or will be predominant in the Sub-Saharan Africa when talking about electricity generation. So here you can see, let me use the pointer, that for both like these two charts, two graphs refers to the stated policy scenario that I already introduced, and also the Africa case, the one aligned with the Africa, like the Vision 2063. And here you can see in both charts till 2020, so actually till 2019, because these charts come from the Africa Energy Outlook 2019. You can see that these are the same, but you can see how first hydropower, which I told you, and you correctly answered in the question I posed you on Menti, is the predominant source of electricity among those technologies. But you can see how in both scenarios, electricity generation is expected to grow a lot. We have more than doubling in the stated policy scenario, and we have the total electricity generation in more or less 2019, which was more or less 300 terawatt hours, which is expected, for example, in 2040 in the Africa case, to reach approximately 750 terawatt hours. So you can see really the difference, and you can see how different technologies play different roles. You can see, for example, how these, let's say, the oil and gas, so fossil fuel-based generation is decreasing a bit if we exclude gas, which is on the other side replacing a bit of what was previously produced by coal and oil. And also we have in gray here, I hope you can see it, but if you have the presentation, you can have it maybe more clear. The backup generators that we also model and that are really important in the continent. But you can see how solar PV is expected to play a major role. But again, we have both hydro and gas that are the, let's say, the biggest, which will have the biggest share in terms of technology when talking about electricity generation. So I will go back to the presentation from my colleague Yasmin, and then we can go back to the Q&A session and close today's session. Let me know if you're able to see and hear correctly.
Order and variable costs. I'd like now to expand a little bit more on that. And so in this section, we will now touch upon some other quite important aspects of power system economics. One very important aspect is how to evaluate the competitiveness of the different electricity generating technology. So competition depends on several factors, of course, cost component, but also when the plant is used, the time of use, and where. For example, if there is a grid congestion in the specific location. And it also depends on the value side of things, the value of electricity generated, and prices, of course, which could be higher generally at peak demand time. A very common indicator that is used to estimate the cost of producing electricity is the LCOE, the levelized cost of electricity, representing the cost of technologies over the project's lifetime. And we can see some indicative values for some of these technologies in the screen right now. The LCOE is measured as average cost per output of electricity. So here, for example, in dollars per megawatt hours. This metric really does a great job actually at putting together all the various technology costs. So talking about the cost to develop, design, license a project, the capital cost to actually build the plant. But then, of course, over the lifetime, which can range from 20 to 70 years, you would have also to pay for operation, maintenance costs, as well as input fuel and CO2 prices when applicable. Of course, on top of that, you would have the financing cost along the way that we generally call the weighted average cost of capital. So this can be quite a significant and disparate set of costs. Would depend on the technologies. And we can see here how the LCOE really does a great job at putting them together in this general formula for calculating the LCOE. We have a more simplified form as well. So the idea now is not to look in detail at this formula, but I would like to highlight one point, that we have two main components: the variable cost that we use also in the merit order, and the fixed annualized cost. And these two components, they change according to the type of plant, and also the proportion, the relative importance is different depending on the technology. One quick example here to illustrate that point is to look at LCOEs by technology in the United States for 2017. Typically, low carbon technologies such as nuclear, wind, and solar PV, they have a high fixed cost and very low variable cost. On the other hand, gas, and to a lesser extent coal, are the opposite. They have high variable cost, and compared to that, relatively lower capital cost than low carbon technologies. Another point to highlight is that financing can be quite a significant proportion, especially for capital intensive technology. And if you have to pay a rate that reflects a very high market risk, then financing can be more important than the actual cost to build the plant itself. One of limitation of the LCOE, and especially in the simplified formula, is the capacity factors that are used is often fixed. So another very useful way to look at things is to see how the cost of power plants is changing depending of the amount of time these plants are used. So in the screening curve is what we call this, this way of looking at things. In the screening curves, you would look on the y-axis as at the fixed annual cost, and it would show how the cost would increase over time, over the time of use over the year, depending on how variable costs are evolving. So this really show different type of technology, and it's really helping us to see the least cost pathway, the least cost solution for each type of utilization, meaning at peak demand, when the numbers of operating hours are really low, up to the base load operation of power plants when they operate all the year, 8,760 hours. So you can see this least cost path in the screen right now. What is also very clear with this graph is that the power technology, they really provide different services. So we can consider nuclear power and coal plants very well suited for baseload operation, the baseload category. So it actually makes sense to compare them in terms of LCOEs. But it would be very difficult to compare a nuclear plant and a gas turbine or GT, which usually provide peak power, as we can see here. Another point is that this curve is valid only for dispatchable plants, and therefore wind and solar PV cannot really be included. They run when the wind blows and the sun shines, so they don't really fit very well in this traditional categorization, baseload versus peaking plant technology. So the question is, for this technology, can we really compare the LCOE to dispatchable technology? So that's one of the limitation of LCOE, especially for renewable plants. So as mentioned, LCOEs are very widely used, and this is because they allow to present in one concise number the generation cost of a plant over its lifetime. There are, however, some limitation, and we really need to keep them in mind when we are using this indicator. I will focus on one of the key limitation here is it doesn't include the value of electricity generated. So basically, if you are an investor and looking at LCOE, you must keep in mind that it doesn't encompass anything on the revenue side of things. The second limitation is that making comparisons across different technology is complex or wrong. You need to go beyond and look at the screening curves as we did earlier for dispatchable technology. And this screening curve concept cannot be applied to renewables technology because of these categories between peak and baseload plants. So we really feel the need to go beyond this limitation. It does a great job, but we want to go beyond to overcome this limitation. And that's the concept that we've been developing here at the IEA with the value adjusted levelized cost of electricity. So the value adjusted LCOE is a new metric for competitiveness. And it really aims at combining costs and the value. And this is really the cornerstone of this concept, combining both. It is using information from hourly modeling of electricity demand and supply, so that we can have information on how the power system operates on the hourly level, but also prices. And prices are really important to reflect the value of producing electricity in any given hour of a given year. So back to the concept of Lcoe. On the one side, you have the LCOE metric that gives you the single cost number. And on the other side, you have the system value. And we can see here 3 broad categories. And these categories are kind of mirroring the new market design that we have seen emerging in many countries, thinking about the European Union, US, Japan, but many others are looking into explicit pricing of electricity services. So the main one is energy value, which represent the value of electricity production on a system at any time to meet demand. So in wholesale markets, which are widely represented over the world, this would be reflected by bids to sell electricity in a given hour. The second category is the capacity value. So it reflects the contribution to system adequacy. Capacity market exists in a number of regions with payment for power plants that can contribute to the reliability of the system. So basically, we can think of it as being paid for being here when needed. And the third one is on the flexibility side, that encompass all additional services that really ensure the quality of electricity services. And this kind of services, they are generally valued through ancillary service markets that are also emerging in some countries. So the concept behind the Lcoe is taking these costs, these values, and merging them. So the energy value is the one that really has the most impact. Selling electricity is today the largest source of revenues in competitive markets. And of the 3 categories of values I showed earlier, this is the energy values that changes the most across technologies. So showing now some hourly outputs, with demand trends over the course of a sample day in the European Union in 2030. You can see these demand trends represented by the blue line. And you can see also the various supply technology that contribute to meeting that demand. So early in the morning, around 4 a.m., wind production is significant. And this is a time when demand is relatively low. So this leads to an excess of supply, and other plants are therefore ramping down. On the other hand, you can see also a need for a big ramp up of electricity output during the evening peak when people are getting back from work. So reflecting these changing needs over the course of the day, the market price changed quite significantly from 0 price in terms of excess to higher price at peak time. So when we do that, not only for sample 24 hours, but for all 8,760 hours of a given year, we can actually derive the price received by each technology. We can then average it over the year. It can be thought as if it was the revenues from selling 1 megawatt hour of electricity on that given year. And that's what we call the energy values. It varies across technology. Again, dispatchable technologies, and particularly the most flexible ones, they are really able to capture those high prices at peak hours. So it means that their energy values is higher than the average of the system. And this, even if they run less hours. For this particular European system, you can see as well that wind and solar, especially solar, produce when it's less needed. So in that case, they have lower energy values. That's basically the idea of the energy value for each region for which we have hourly models. So this is the United States, the European Union, China, and India. We derive from hourly operations the annual energy value for each technology. And we do this for every year projected in our outlook and for all our scenarios. So from this hourly information, we can derive also the capacity value, so the contribution to system adequacy. Can you rely on this technology to produce electricity when the system needs it the most? Dispatchable power plants are generally available in all hours, except in extreme cases such as disruption in supply chain or extreme weather, for example. And they have high capacity value. They can generally contribute to something like 80% of the peak or even above for some technologies. And for variable renewables, it would really depend on the degree of variability and how the output of solar, the output of wind is adequate and coincide with system needs. So in this example of the European Union here, we can see that their lower ability to contribute to the evening peaks would mean a lower capacity value. A quick word on the flexibility value. This is really the most difficult one to represent. In the ancillary service market in Ireland, we have more than 20 products from primary, secondary, reserves, regulation, frequency controls, and it is very difficult for a global model such as the World Energy Model to represent that kind of details. So our representation is really derived from this real world existing ancillary markets value, and we take into account how it increased with the rising share of variable renewables as it is quite obvious that this flexibility values is linked to the ramp up of these energy sources. Now, keep in mind that this is an example, and this is very specific to the European Union demand and supply pattern. It would look very differently in a system where the demand peak is more aligned to, let's say, solar output. We can think of a warm country, a sunnier country, and in that case, the peaks occurs generally at noon, and this is very well suited to solar PV, which can be able to meet cooling needs linked to this particular system. In that case, solar PV would be able to capture at the same time peak hour high prices and also to better contribute to the adequacy and have higher values. Now, how do we put all the pieces together? For a particular technology, we start with the LCOE. Then we would simulate in a given year the energy value for this technology. We do that for all technologies, so we are able to compare to the average energy value of the system. So here, for this very illustrative example, we can see that the technology has a higher value than the average of the system. So it means that it is more competitive. More competitive means that we need to adjust the cost and reduce it to reflect that. So this is what we do. We take the difference with the average energy value of the system and make this adjustment on the cost side of the metric. Now on the capacity value, the contribution to adequacy here is relatively low compared to average. So that means that the technology is less competitive than others on that specific category. Less competitive, therefore more expensive. And now the flexibility value. Again, not a very high value compared to average, less competitive. We adjust by increasing the cost side of things. So we take all these three value adjustments, we apply them to the LCOE, which leads to the value adjusted LCOE, the Lcoe. So now to summarize the Lcoe concept, it does provide a more sophisticated metric of competitiveness. It includes these elements of value that the LCOE was missing, and it makes it robust across a wider set of technology. It is not perfect. A few of these limitations includes that they are not site-specific, so the network integration cost, for example, is not there, and it doesn't include externality costs that are not priced. So, for example, air pollution. The Lcoe is not the only metric looking beyond the LCOEs. For example, cost and benefits aspects are already taken into account in profitability calculations, such as the net present value. We have also some academic research looking into it. The US Energy Department, they also have similar metrics. In the real world, we have some application of very similar concepts in some auctions in Mexico, for instance. So to conclude on this concept, it's really part of a bigger family of beyond LCOE metrics that aims at providing useful information for energy modelers, system planners, and investors. And talking about investors, a very important outcomes of models is the amount of investment that is needed overall in the sector and for each technology type, as well as all the related infrastructure. So beyond spending on power plants that we would derive from capacity additions and their unit capital cost, we also see here that electricity networks also need to be expanded, maintained, and digitalized. So we model this network through a dedicated module that derives transmission and distribution grids infrastructure really needed to support the expansion of the power system and also modernize existing aging assets. We have additional constraints to the model that can be added to simulate more real-life investment constraints. And there are really important policy implication, market implication that can be derived for this investment to be really happening. Otherwise, the lights would not be kept on. So this kind of really coming back to the Lcoe, so that really highlights the need for investor and policymaker to have the right signal for investments. So the Lcoe concept is really important to improve the LCOE concept in order for them to have a clearer picture of competitiveness across technology, which is really essential to develop long-term plans and long-term goals. So I would like now to summarize the main calculation that we've been through: installed capacity, electricity generation, fuel inputs, CO2 emissions, but also kind of recall the relationships among these main elements. So we have capacity factors and merit order that are linking installed capacity and electricity generation. We have efficiency that connects electricity generation and fuel inputs. Fuel inputs and CO2 emission are related through emission factors. When we have gross capacity addition, then this helps us to determine the evolution of overall capacity by type. And we can calculate total investment thanks to unit investment cost. And all of these elements are related between them, and they are summarized using the LCOE metric despite its limitation. We have now reached the last part of our presentation on the power sector. And for this very last section, I would like to introduce the basic principle of the concept of variable renewables. What are their constraints? What are the solutions to integrate them into power system? So why are we looking at wind and solar PV technologies? The answer is quite easy. They really represent the biggest change and success story of the last 15 years. Solar PV is the new king. It's the most built technology over the past 3 years. It's the cheapest source of electricity in most countries over the world. And beyond these recent trends and historical trends, we see, looking forward, a greater role, a greater share of this technology to decarbonize power system in the future, to decarbonize the whole economy. But a point to keep in mind when we are talking about wind and solar PV is that the electricity generation, their output, is really depending on the underlying natural resources. And we can see on this slide how these outputs evolve over time because they are linked to the natural resources, they are linked to meteorological conditions. So this variation can lead to several consequences that can be summarized with really 3 main characteristics. That would be scarcity, abundancy, and variability. Scarcity is the situation that happens when these non-dispatchable renewables, these variable renewables, they do not provide enough generation to cover demand. So this requires other type of operator, other type of plant units to ramp up to meet demand. The second point, abundancy, is the opposite. It's when we have too much generation, too much output from wind and solar PV in the system, which leads to excess generation compared to demand. We saw an example earlier with the European Union. Then the third category, variability, is really the extent and the speed of the change of the outputs. For instance, the speed at which solar PV ramps up for the noon peak and ramps down when the evenings come, that needs to be compensated by other means of production. The impact of variable renewable energy sources would also depend on the level of deployment. At low level of penetration in the mix, the effects are really negligible. Power systems were built already to be resilient, to be able to accommodate the variability of demand. And when solar PV and wind share is low, the variation of demand from 1 hour to another is more important, has more effect on the system than this variability coming from solar and wind PV. But when we go beyond that, we begin to see some impact. Impact on total installed capacity. One key issue is the higher flexibility needs that would be needed from the system, the higher ramping requirements. There is an impact on the load duration curve, an impact on dispatch, on prices, and consequently on market design. And finally, an impact on how the network is used, on how the network can accommodate this variability. On the impact on the load duration curves, we first need to introduce a new concept, the concept of residual load duration curve. So we can apply all the reasoning that we discussed earlier to this residual load duration curve instead of the load duration curve that we saw earlier in the presentation. So what is this residual load duration curve? We take the hourly electricity demand, so here over the month of January, and then we would need to subtract the generation of the variable renewable energy sources. Here, this is solar PV. And the result is the light blue curve, the residual demand. Then, same concept as the load duration curve, we reorder the hourly demand from the highest to the lowest. And depending on the penetration of solar PV, you can see different impact, the biggest impact being the one with 60 gigawatts of solar PV. Looking at this example of 60 gigawatt and focusing on it, we can see that it generally has a main structure, but steeper than the original load duration curve, with big differences for base load and for peak load generation. This is a peak here load duration curves that requires less base load production means. We can have a clearer view of this phenomenon in this slide, where we can see how this would impact the total firm capacity needs. They do not change significantly overall, but as mentioned earlier, peakier, more peakier needs and less baseload needs. Now, zooming in a day, a sample day. So here again, the same concept of residual demand with the total demand in red. And when we remove the solar output and the wind output, the result is the residual demand. What is really important in this zoom at the day level is we see very clearly the impact on the rest of the system. Here, when the solar output ramps up, then the rest of the system in green needs to ramp down to compensate this. And the same happens in the evening. When the solar output is coming down, then the rest of the system needs to adapt to compensate for this. And this is the basic concept behind this very famous curve. So this is showing the impact of growing variable renewable production in California. So this is the duck curve. We can see the stomach of the duck getting bigger and bigger as the share of variable renewable production in California increased. And we can see how the neck is becoming steeper and steeper, an unfortunate conjunction of decreasing output for solar, but this is also combined with a peakier demand with evening peak. So now that we have a bit described this impact, how can we really put a quantification on this impact? First, a very concrete way of measuring it is, in case of excess, the amount of curtailment that is needed. And the impact would be also the number of hours with the near zero price, which we saw also earlier in the case of EU. One implication of this is that it would decrease the attractiveness in new projects. So if we don't tackle the integration projects, new renewable projects would be less and less attractive to investors. And in that case, this would compromise the pace of change, it would compromise the pace of energy transition. So we need to avoid or at least limit the extent of this implication. And the good news is that we have several integration measures that are available to policymakers, to policy planners, and for markets. We can summarize this in increasing the flexibility of the power system, energy storage, demand-side management, as well as interconnection between demand areas, between countries, between regions, and the role of that would play network transmission and distribution grids. So these four categories, I'll come back to this in the next slide. You can see how these four main categories here displayed in that graph with different colors. For example, flexible generation solution is in blue. So we can see how these categories, they fit in the general flexibility landscape. With decentralized options, the decentralized solution at the bottom, and utility scale solution on top. And these options, they are ranging from very, very short-term flexibility within the minute or even a second time frame. So this short-term is on the left, for which we can see, for example, storage that is quite well suited, and very long-term arbitrage, seasonal arbitrage, where, for example, grids would play a role, and flexible generation is a bit everywhere in this landscape. So we have seen that we have flexibility needs at the second time frame, at the seasonal time frame. One way of measuring flexibility needs can be also at the hourly level, and specifically the hour-to-hour ramping needs to fully integrate wind and solar PV and respond to change in demand. So here you can see those needs in 2019 in 4 major regions. Each dot here is representing an hour of the year. So for example, across the entire European Union, we can see that a very large upward change in dispatchable output from 1 hour to the next was needed, and about 20%. This happened when demand was rising and both solar and wind power were declining. So this is today, but in the future, flexibility needs will be much, much higher. The changing shape of electricity demand and the strong growth of solar PV and wind power, together, there are increasing flexibility needs in power systems around the world. So average hour-to-hour ramping needs almost double across most major power systems to 2040, with very much higher increase in some systems. We see a striking trend for India, where in certain hours, we will see the need for dispatchable sources to ramp up or down by well over 50%. The good news is we have those flexibility sources that I talked about earlier: power plants to electricity network, storage technology, demand side response measure. So coal and gas-fired power plants are today the main source of flexibility, and they remain so in the future. There are also some contribution from low carbon sources like hydro and nuclear power. But looking ahead, many power systems will need to rely on other means. Storage and demand side response will play a central role in flexibility, provided that we have the right policies and regulation to make this happen. And of course, on top of all these sources are grids. So solutions exist. They have a different range of impact, and the optimal mix of this solution would depend really on the characteristic of each power system.
Okay, perfect. So we go back to the presentation. You should be able just to see the question and answer icon. So we have been joined by my colleague Yasmin. Hi, Yasmin.
Hi, Dalen, and hello, everyone. Very happy to be here and to reply to any question you might have regarding this quite big modeling session on power system.
Yeah,
Hope you enjoyed it.
Yeah, thank you very much for joining us. So we will close the session with this, today's webinar with this Q&A session. So feel free to raise your hand if you have a question for me or for Yasmin, so I can give you the possibility of unmuting yourself and also turn on your camera to directly ask your question, or otherwise you can use the Q&A box.
I just hope that this was very clear and that you don't have any question. I know that this is a dense presentation, so really feel free. I'm happy to go back to a concept, go back to a methodology, or anything related of what could be applied to the particular Rwanda situation, or anything, really anything.
I don't see any question actually, neither raised hand. So I will just, for the moment, just quick reminders for the next webinar. But again, feel free if you have questions to raise and then write in the Q&A box. Today, since today's lecture, as Yasmin pointed out, was really dense, we will skip, let's say, the exercise during this webinar. So I suggest you to, as we did for the previous webinars, to have a look at the handbook that is on the Google Drive repository. You can use the PDF file and then move to the Excel file, starting from, let's say, the clean version in which you don't have the solutions. And then if you have doubts, move to both the chapter of the handbook which has solutions, and also you have the Excel file which already has all the formulas, etc. And if you still have doubts, feel free to write me and I will forward your questions. Like if I am able, I will try to answer you and see with you the question. Otherwise, I can forward it to my colleague Yasmin. I see two, okay. Okay, so Peace is asking for the drive. I will do it. And then we have an anonymous attendee, which also has a question. I will leave that one with Yasmin and I will find the link for the drive.
Yes, absolutely. So I see a question on the difference between the operational attributes of a variable renewable energy and a normal power plant connected on the grid. So really the key difference is that they are not dispatchable. So the concept is that a wind onshore farm, PV plant would operate only when the sun shines, when the wind blows. So they would have this input on the grid, whereas for example, a gas plant, you can very quickly ramp up the production of a power plant fueled by gas or ramp down. So this is why we make this distinction between variable renewables and the other dispatchable sources. For example, there are hydro that are renewables, but part of them can be dispatchable. You release some water in the dam, and then you can produce electricity, or you cut the turbines and there is no electricity. So there is this possibility also for renewables to be dispatchable. Geothermal is another category, but most of the dispatchable we think about is gas or coal plants or even nuclear, where you can less easily but still ramp up and down whenever you want. Then the speed of the ramp up and down would depend on the category of plant. Nuclear plants obviously are not easy to shut down or to turn on. So it's we're counting still a few half an hour or something like that to be able. They operate more flexibly in France because France system is very reliant on nuclear. But this is the key difference. And this is why when you have a bigger share of variable renewables, it has an impact on the rest of the system. It means that the rest of the system that can ramp up and down whenever needed needs to do that much more. So I hope this answered the question.
Perfect. Thank you very much, Yasmin. I think your answer answered this question from our anonymous attendee. Otherwise, I kindly ask the attendee to, if you want, you can write an email to me or to Yasmin, and I will, and we will try to answer. I just wanted, if you have other questions, again, feel free to write them on the Q&A box or raise your hand. In the meantime, I just wanted to close showing the result of our live polling for the last question we had on menti.com, which was, what is the first characteristic that comes to your mind with respect to solar PV? So we had this kind of words map that came out from what comes to your mind when thinking about solar PV. And I just wanted also to share it with Yasmin.
Yes, I
Okay.
find it very, very interesting. So we come back to this concept of variable, but
Yeah.
also one key aspect is the distributed generation part of solar. It plays a key role, notably for access to electricity because of this distributed attribute. Then battery storage, which is absolutely very important to kind of counter this variability of solar PV, so that you can stock the energy when the sun is shining, and it's probably depending on regional context, it's not generally when it's needed, but you would need it also in the evening. So then you stock the solar energy thanks to batteries, etc. So very interesting findings. Thanks.
Perfect. Thank you. Thank you very much for also adding some context. Okay, so I don't see any question. So again, feel free if just one other information. As you know, the recording will be available as up on YouTube, so that you will also have the possibility of rewatching today's slides. So maybe some new questions will come up while doing that, and also while doing today's exercise. So thank you very much for Yasmin for joining us, and thank you to all attendees for participating to today's webinar. Tomorrow we will have our fourth webinar on the modeling track, in which we will address the oil and gas sector. So I will close here the session and see you tomorrow at 3 p.m. as it was for today. Thank you very much. Have a nice day.
Thank you, everyone, and wishing you a very successful end of webinar. Bye-bye.
Bye. Thank you. Bye.